Again, this is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth and Management. Today is Tuesday, April 25th of 2023, and then we're going to talk about three topics that are moving the markets. We're paying attention to them at Blanke, Schein Wealth Management, so you should be too in what's to be expected here. We're talking about the earnings update right now. We're in the first quarter earnings reporting season, and so we're getting a lot of clarity as well as sort of the guidance of what we are expecting from corporations on what they see in the economy as we speak. The Fed in Washington are always in the front and center, so that's always moving markets, whether it's policy or the Federal Reserve, as well as a real estate update. We did get some real estate news today. But basically, tomorrow we got an action-packed week. We got the results of the first quarter GDP, gross domestic product, and basically the GDP, we're about a $20 to $19.5 trillion economy, and it's called, basically, it's the everything economy that basically makes and buys and sells in terms of how the economy just grows. And ultimately, it's supposed to grow about 2.5% to 3% per year. So the piece of the pie grows larger, but this could give us an indication of a contraction. So if we have two consecutive quarters of the GDP contracting, that would then indicate a recession. But there's several different variations of recession. There's a technical recession by that definition. There's also the consumer recession. We'll check in on the consumer as well as for earnings recession. And that's the biggest key here, are earnings hanging in there. But we're also going to get a lot of clarity because keep in mind next Tuesday or next week, we got the Federal Reserve on tap once again about another rate hike potentially. And right now, there's about an 80% chance that the Federal Reserve will move again based upon the information that they have right now. But that could change. As we said, the data is the Federal Reserve's data dependent. So we got the consumer confidence, which we received today, which was lighter than anticipated. So that just means that the consumer, again, the GDP is based upon the consumption and goods and services in the economy. And if the consumer's confidence is starting to draw down a little bit, they're not going to feel so good about spending, obviously, because there's inflation and there's a lot of uncertainty moving forward. So that has a knock-on effect to corporations and balance sheets if the consumer holds back. So we did get sort of the consumer confidence read today, which was lighter than anticipated. We got new home sales. We'll talk about that in just a minute. And then tomorrow we've got durable goods and the first quarter GDP. And then Thursday, jobless claims, pending home sales, and core PCE inflation, which is exactly what the Federal Reserve is actually looking at right here. Is the Federal, and then the PMI, Purchasing Managing Index, on Friday. So chock full of a lot of data that the Federal Reserve needs over the next 72 hours, if you will. The overall liquidity, what the Fed is really, what we're concerned about is what the Fed has done positioning-wise based upon this last quarter's banking crisis. As we've talked about, it's in the forefront of the market today. Even the small regionals are having difficulty. So the Federal Reserve has added to the liquidity pool to help the overall liquidity situation. But they're showing that the overall liquidity on the Fed's balance sheet is contracting. That's the purple line here. And when that happens, meaning when they have to step up and help out, which they've been doing, that also markets tend to follow that line. So right now we've got a clear divergence. So you see the purple line, which is the Fed's liquidity is contracting. And then you have the S&P 500 clearly going the other direction. So we could see some pullback in the markets if they continue to follow this trend as we've seen before. We talked about the consumer confidence. It came in at 101.3 versus the 104.4 estimate. But here's, consumer confidence is weighing, but the biggest part of the economy, one of the largest, is housing. And housing actually reported today better than expected, especially on the real estate side. The prices are up year over year, as well as the real estate update. You have new home sales are up in the month of March 9.6%, or basically 863,000 units versus the 834,000 units, which were expected. Now, why would that be? It's basically the new home market is, the new home buyers in terms of that supply is drawing down. 8.6% in terms of month supply versus 8 months supply. And the existing home sale is basically down to only a 2.5 month supply of what's available on the marketplace. Again, why that is listen, if you got a 3% mortgage, there's no need to trade up unless you have to move for all the obvious reasons. Let's say you're moving, relocating for a job, but from the really normal real estate market, if you're in a good mortgage, you're not going to put your home on the market unless you have to sell or you want to capture some profit or something of the sort that matter. So what that does is reduces the amount of inventory from existing home sellers because they already have a good mortgage. Now, what's bringing or drawing in, for the new homes? Why is that basically drawing down as well? If you have to walk in to, let's say, one of these new housing developments, and you're going to be, looking at 6 to 7% mortgage right now. Well, what's happening is that what the home builders are doing are adding drawdown or the incentives or increasing, not decreasing the sales price to get you to buy the house, but they're adding in sort of more upgrades. So they keep the housing price, let's call it $500,000, still the same, to keep the demand in the door and the price stability of the neighborhood, of that complex, of that development. But they'll add in more underneath the bottom line, so upgrades. So that would give the incentive, again, for the new home buyer from a new home development. Say, hey, listen, if I can get a little bit extra, maybe a pool or maybe another $25,000 in upgrades, but still lock in that $500,000 mark, I'll still buy it. Or what they do is they do a mortgage buy down. So they'll buy you down 1 point or 2 points on your mortgage to take you down from the 6 to maybe a 4.5% mortgage, with the thinking that for 2 years you're locked in at the 4.5. The developer gave you that incentive, working with the lender that they have, usually their lender of choice, that you qualify through, and you get they have a deal where they'll knock you down 2 points, in hopes that, and the strategy would be to get you in the home today, for the developer to sell that property, and then on the backside, in about 2 years, you would anticipate, the bet would be, and the wisdom would be, interest rates would be down from 6, and you can refi maybe at a 5% level or something lower. So there's all these incentives that home builders are maintaining the price. A lot of people are waiting for prices to come down on homes, and they are in certain select areas where they are over developed and over sort of invested, if you will. But for the most part, housing prices are hanging in there, and movement is still happening, and inventory is still coming down. So it's a key critical sort of component to pay attention to as we go through this. So that's our update in terms of what the Federal Reserve is sort of on data dependent mode. Again, I wrote Washington in there at the very beginning because it's going to persistently come in. More granularity and clarity we get on the tax receipts from last week's tax deadline is really going to set the stage for Congress and Washington to basically have the back and forth conversation about the debt ceiling. And that's another critical sort of timeline that's going to play out once we find out how much money is in the coffer from the collection of the tax receipts. So we're thinking still early June is the standoff. The Washington is going to basically play a game of chicken, and I think that's going to provide more volatility moving forward in the equity markets. And then the Federal Reserve, again, is going to hopefully see what they do next week with the 25 basis points or not. But that's our sort of three main things. And then earnings percentage, actually 77% that have reported for the S&P 500 have all been in line or beat expectations, and only 2 companies out of over 150 that are reported reduced guidance right now. So earnings are hanging in there. And that's what's interesting. But we've got the big hitters this week, right after the bell today and later this week. So it's a big portion of tech earnings are going to hit, and we're going to see sort of a lot more clarity again on the earnings picture. So tune in for that, and I'll be back on Thursday. Thanks for watching, and we'll see you again next time.